So just a sort of journal entry, tabular summary, a bit of a simplification over everything we just covered. Here's an inventory system under the perpetual system. Here's an inventory system as it would be recorded under the periodic system. If we make a purchase, I debit inventory and I credit the means of payment, whether that's with cash or an account payable. Under the periodic system, instead of going to inventory, I debit my adjunct asset purchases and credit the means of payment. When I make a sale, right, I receive cash, or perhaps someone bought it for me on credit. So I record the cash or the receivable with a debit, I record my sales revenue, and I automatically trigger debiting cost of goods sold and crediting inventory at the point of sale, because I want to perpetually update my cost of goods sold and my inventory every time something's sold. Notice that under the periodic, of course, I still record the revenue and the cash or the receivable at the point of sale, but there is no update of the inventory account or cost of goods sold at that moment. Under the periodic system, I record those sales and report the correct reduced or the correct end balance of inventory by making this large adjusting entry. And it is an adjusting entry. It's just one hell of a huge adjusting entry. Notice you'll see that I'm closing all four of these accounts that are recorded under the periodic system. As I was mentioning, this is when they're closed, when we record the cost of goods sold and inventory. I debit cost of goods sold for the amount. Understand that this is the cost of goods sold for the entire period. So all of the sales I made for the entire quarter or year even. And also notice it's a little strange. I have a debit and a credit to inventory. This is a way of making the process somewhat simple. I know where I began and I know where I ended. And those are the only two things I know under the periodic system. So this is basically crediting my beginning balance of inventory at the end of the period and debiting my ending balance of inventory. And let's look at that real quickly. It seems complicated, but it's actually a really simple thing. Suppose that I began with $10 of inventory and my end physical count was $6 of inventory. So ignoring everything else that's going on, if I have my inventory account and under the periodic method, I'm not updating it at any point, all it will start at, it'll start out at 10, and that 10 will be there from the beginning of the period all the way until this adjusting entry is made at the end of the period. And if I go in and I count $6, well, I want to establish a $6 balance here. And there's really two ways you can do it. You could just do the net movement. You could just say, well, I credit inventory by 4 and just do one entry to inventory. But just to make it, I don't know, simple by adding one more step, I'm just crediting my entire beginning balance and debiting my ending balance, which is the same thing as crediting it by $4 overall. But that's all that debit and credit to inventory are doing. They're erasing the beginning balance, setting up the end balance so that my end balance is actually the amount that I counted. Under the perpetual, no cost of goods sold is needed to be recorded at this point in time. This entry is to record any lost or stolen inventory. Lost, stolen, spoiled inventory. Because remember, I get that expectation. I have already an ending balance of inventory that should be accurate according to the amount that I sold, because I've been updating my inventory consistently at every sale. And I go in there and I count, and if something's missing, then I assume it was lost, stolen, ruined. And this is recorded. You can just record it as a loss on inventory, or you could also, it's also frequently referred to as inventory shrinkage. Anytime, I mean, someone asked if you could have a gain in this situation. If you have a gain, if you know, typically that means that an error has happened somewhere, like you misrecorded a purchase, or you misrecorded a sale somewhere. You know, it's not the case that, you know, someone just like brought an apple and decided to toss it into your inventory or whatever you're selling, right? Oh, we got an extra iPhone. Someone must be really nice and decided to donate their iPhone to our inventory. So yeah, you can have that, but you wouldn't record it as this. You would record it as an adjustment to either the inventory purchase that might be that you recorded too little purchase, something went off, or the sale, like you recorded too little cost of goods sold and too little of a credit to inventory. Also, this is an operating loss. So this is our operating expense. Even though it says loss, it still appears in the income statement as an operating expense. And some companies even just combine it into cost of goods sold. All right. So I got, you know, just a little bit, some tips. Basically, don't memorize this. It's too much. And you memorize something that big, you're not going to make any sense of it. Think it through. Understand that, like, for example, since these are both contra accounts and they should be somewhat readily identifiable as contra accounts. What happens when I discount something? I lower its price. What happens when I return something? Well, it shouldn't be there anymore. So I'm lowering the amount that I, you know, expect to have in my inventory. They're both contra accounts. They're contra to assets. Contra assets have credit balances. And so to close them, I need a debit balance. I need to debit them. Purchases adds to my total inventory. Freight adds to my total inventory because it's part of the cost that I include when I'm bringing my inventory in. And so those are adjunct assets. Adjunct assets are increased with debits. So to close them, I need to credit them. This silly little trick with inventory, just wiping out the balance and putting it where you want it, that explains the debit and credit there. And then finally, cost of goods sold is my plug. Basically, what that journal entry is doing is putting into a journal entry this entire equation. And that's why cost of goods sold is my plug, because it's the final item I arrive at. I have facts, I have receipts, I have a physical count, and from the facts, receipts, and physical count, I come up with what I think cost of goods sold is. All right. So, you know, what is included in my inventory in my, you know, actual asset account is what I'm saying, asset balance. So what is in the asset account inventory? When do we record a purchase or a sale? And that's going to determine, you know, well, when I debit purchases or debit inventory and credit the means of payment, or when I want to debit cost of goods sold, credit my inventory. The key here is, and should mostly be reviewed from intro, that the company, it's about legal title, and it doesn't matter about location. So location doesn't matter. If we have legal title, it should be in my inventory account or my purchases account. And so the exchange of title is the point at which I record the journal entry. Purchases should be recorded when legal title passes to the buyer. So that's when the purchase journal entry is made. And of course, when legal title is given to the person who you're selling it to, then that's when we should record the sale. So some things to think about whenever there's goods in transit, right? Whenever we've sold something or have purchased, and so either we've sold some inventory to somebody, another company, a consumer, a customer, or we've purchased inventory from a supplier. If it's still in transit, right, it's being shipped, then we have to be very careful about whether or not we want to count it. And the two terms that are used with this shipping arrangement are free on board, or is it free or freight? I always forget that. So it's FOB is the acronym, shipping point, FOB destination. So if it's shipping point, we concentrate on shipping, and that means that the title has exchanged as soon as it's been shipped. Well, if it's in transit, it's been shipped. Therefore, the purchase and the sale should be recorded as soon as it's shipped. So these things are included in my ending inventory. So we record the purchase and the sale, depending on whether I'm the seller or the buyer. But these legal title has shifted. So the buyer debits inventory, the seller credits inventory, and that's what happens on that arrangement. When it's FOB destination, on the other hand, we do not count these things in our ending inventory if we're the buyer. We still count them in our ending inventory if we're the seller, because the title will not shift until it reaches its destination, right? It's still being shipped, hasn't gone to its destination yet. So we do not record a sale or a purchase on items that have yet to reach their destination if they've been shipped FOB destination. Sometimes there are some consigned, I can't speak today, consigned goods, consignment. I know why I'm having an issue with consigned goods. But basically what we're doing is getting someone to sell on our behalf, right? This is what we call a principal agent relationship. If I'm taking a piece of inventory I have to somebody else to sell it on my behalf, then I'm the principal. The person who's working for me is the agent. If you think about, some companies have arisen that model all their operating activities on being the agent. If you think about a lot of travel agencies, Priceline, hotels.com, they're not the principals. The principals are the hotels and the airlines. They're the agent. They're making the sale happen, right? So the person, the consignee, the agent, does not have the risks and rewards of ownership. They're merely they're selling it on behalf of the principal, i.e. the consignor. And therefore it's not their inventory, right? The inventory remains titled to the principal the person who's having it sold on their behalf. And it's in their inventory. So when you think of the principal, think of the hotel or think of the airline, even though the inventory doesn't really work in those two relationships. But they are not the Priceline.com. Priceline.com is the agent. They do not own the service that they are selling. So goods that are on consignment remain the property of the person, even though the inventory is no longer physically there. So there are some special sales agreements, and the transfer of title may not necessarily be accompanied by a transfer of risks, which means that, like, for example, if we have sales with a high rate of return, if you recall on chapters 5 and 7, when we estimate the amount of potential returns, there are inventory adjustments that go hand in hand with that. If the returns can be reasonably estimated, then we use that estimation to adjust our cost of goods sold and inventory accounts. And that's usually done in tandem with the sales return entry. And I have just like a little example of that, even though we've seen it. The company made credit sales of $375 during the month of January. It estimates 3% of these sales may result in customer returns. Mira determines its sales policy by performing a 40% markup on the cost of its inventory. So it has credit sales of $375. And thinks that 3% of these are going to be returns. Let me grab my phone. So that's $11,250. And that would be my estimate of sales returns and my allowance for sales returns. And it says that there's a 40% markup. So 11,250, using the old trick my like fourth grade teacher taught me, equals 140% of, becomes a multiplication sign, and we have a dollar value because it's a 40% markup on the dollar value of our item. And so in order to find out the dollar value, I divide 11,250 by 1.4, and I get that it's a little bit of a messy number. So I'll just round that the dollar value should be $8,036. So this is the cost of inventory estimated to be returned. And so when I have that estimate, that's where, even though I've sold it and technically for a sale, the legal title has passed, but the risk of it being returned is high enough for this amount of goods that I record a debit to inventory, because basically I think it's going to come back to me. Debit estimated returns and credit cost of goods sold. I credit cost of goods sold because when I sold the inventory on account, I debited cost of goods sold for the amount of it, for the total amount of all of $375,000. And I credited $375,000, or the cost of $375,000 of inventory. Well, because some of it's going to come back, I need to reverse some of it as well. If the amount of goods cannot be reasonably estimated, then they should not be removed from the seller's inventory account until the return window expires. So we don't make an adjustment to cost of goods sold or the inventory account under either the perpetual or the periodic system. I'm going to kind of skip on B and C. These are very specialized transactions. It's a way of sales with buyback agreements, sometimes called parking transactions, where I sell the inventory, but I have an underlying promise to buy it back. So basically, I have this way of getting some money for inventory for a short period of time, maybe to get some liquidity for the company. And then I'm going to turn around and buy it back when I have some more cash flow coming in. And bill and hold transactions, another reason, another sort of like advanced transaction that's not extremely pervasive in the world. So you can worry about these later when you have inventory down. What's included in the cost of inventory? So what do we want to keep in debit to inventory or debit to purchases? All costs for manufacturers that are traceable to the production of the product. Okay, so that includes direct materials, direct labor, manufacturing overhead, some of those managerial buzzwords. All of those things go into inventory, and hence they will also be debited out as cost of goods sold when those items are sold by the manufacturer. Product costs are directly related to bringing the goods to my place of business. So we're talking about freight charges, transportation costs, other direct costs of acquisition. So if I have to get some sort of insurance on it, and any labor that is required, any labor or production to get goods ready up to the time of sale. So like maybe I have to package it, I have to put something together, I have to add some bells and whistles before I put it on the shelf. Anything, all costs to acquire and ready the item for sale are included in inventory. So costs that we don't include in inventory, the costs that are indirectly related to the acquisition and production of goods. So if we have like selling expenses on the inventory, we pay wages to employees to work the floor. Perhaps we even pay them commissions on their sales. Those are not inventory cost of goods sold. Those are selling expenses that are, just a regular operating expense, not cost of goods sold. General and administrative expenses, well, certainly we have to have a storefront. We have to pay rent or a lease payment on that storefront. We have to have electricity. Those sort of things are general and administrative costs, not part of cost of goods sold. And interest expenses, and interest expense we'll see in a bit comes in because we have the possibility of purchase discounts forfeited. And that should sound vaguely familiar. In the receivables chapter, remember, so for receivables, we had sales discounts and sales discounts forfeited. We have analogs in the inventory chapter, analogs just being a comparable, similar thing. in the inventory chapter, we have already seen purchase discounts. And we will also have purchase discounts forfeited. The first two on the top row are only recorded under gross method. The bottom two are only under net method, cash discount accounting. And if you consider it, basically a receivable is just the opposite side of an inventory transaction. I'm selling merchandise, and by selling merchandise, I debit accounts receivable, I credit sales revenue. Well, I'm selling it to somebody, right? The person I'm selling it to would debit inventory, credit an account payable. And as the seller, I'm offering the buyer an incentive to pay quickly. Well, if they take it under the gross method, I record a sales discount. If I'm the buyer and I use the gross method and I take the discount, I record a purchase discount, right? So just two sides to the same transaction. I want to look at, just now that we've talked about everything that's included, the adjunct, the contra accounts, and perpetual periodic systems, let's look at what happens with an agreement with all these different factors rolled into it, and using a credit purchase so that we see the potential for those sales discounts or purchase discounts. So it says Kyle Inc. entered a credit purchase agreement with its supplier, buying 12,000 units FOB shipping, right? So we want to keep track of that because that's when title passes. Each unit costs $10. That's the invoice, plus $1.50 per unit shipping, has a 10-day return window when the inventory arrives. It arrived on the loading docks on 1/5/16. The company found 140 units to be defective, returned them to the supplier. Kyle incurred labor and material costs of 50 cents per unit to get them in a final saleable condition. So if we're looking at this from both the perpetual and the periodic methods, we'll assume that they shipped on 1/1/6. That's when title would exchange. I'm sorry, 1/1/16. Title would exchange. So we record the purchase of it on that date. I'm going to do the blue will be my perpetual unit, will be my perpetual purchase record. And I'll do the other in green, the periodic. Notice we don't have a sale. No sales are embedded in here. So we're going to hold off on that portion of it, but we're just going to look at the purchase portion, which is enough kind of at our outset of how we're approaching this. On 1/1/16, 12,000 units, 10 per. So under the perpetual method, we would have $120,000, and I'm going to separate the freight and the invoice costs just to emphasize the point of the difference between perpetual and periodic. So we debit inventory, credit accounts payable because we're paying for this on credit. 12,000 times 10, 120,000. $1.50 shipping. Because it's perpetual, that shipping just gets included into my inventory. 12,000 times $1.50 gives me $18,000. And it doesn't say, so we'll put it in cash. That's where I tend to put freight. I'll have to check McGraw-Hill to see what they do, if they treat freight any different. So we're trucking along. And let's look at what periodic would do. On the same date for the purchase, replace inventory with purchases. $120,000. Still are recording an account payable as a means of payment for $120,000. In this case, it's no longer inventory, but freight. $18,000. So no amounts change. Just how I deal with processing the inventory through my system. Do I just call it inventory? Do I call it purchases and freight? So then it arrives on 1/5. They find some defective stuff. And if it had been shipped FOB destination, we would record this purchase on 1/5 when it arrived, right? If it was FOB destination, but it was FOB shipping, so we record it when it ships. The 140 units are returned to the supplier. And so it's 140 times $10, which, oh, I didn't even need to do that, which would be 1,400. So now I'm crediting inventory for my returns on 1/5/16. Because I'm under the perpetual system, I'm just going to credit it directly. Those are going back. Notice I don't get reimbursed because I haven't even paid yet. I have this on credit. So it's a debit to my account payable. It's a debit to the total amount that I'm going to have to pay for this inventory. So that reduces my liability slightly. It also reduces my assets. Over here on the periodic side, I would have to credit purchase returns and debit accounts payable for the same amount. And if freight were reimbursed, well, it's just the same process. I just reverse this entry here or that entry here. I'll just write that in. I didn't say it in the problem. If freight is reimbursed for returned units, then I have $1.40 freight per unit, $1.50 freight per unit, 140 units. So that comes out to $210. I would credit inventory $210. And that I would get a cash refund back on because I paid the freight in cash. And same story here with the cash and the amount, but I credit freight because I get some reimbursed. And if they incurred labor and material costs of 50 cents per unit to get these items in a final sellable condition, well, they had 12,000 units. They sent back 140. That nets them 11,860. So 11,860 units remain after return. And we have 50 cent costs to ready for sale. And I know from my discussion above, I got to include that in my inventory. So under the perpetual method, that would be 11,860. Oops. Yeah, 11,860 divided by 2. Oh, wow, that's a lot of money. I would debit inventory by that amount, 5,930. I would not debit an expense. Notice, I would debit my inventory and it would be recognized as an expense when it was sold. Here, I would do purchases, would not, remember, we do not touch inventory until we make that final adjustment at the end of the period. So that does not get touched under the periodic system. So these are the two systems. Like I said, this is what kind of creates that difficulty, I believe, in this particular unit on inventory, is that we have basically the same story, but it changes based on the system we use. And, you know, there's a lot of iterations. And once we start talking about LIFO, FIFO, average cost, understand that you can have LIFO perpetual or LIFO periodic or average cost perpetual, average cost periodic. So you have a lot of different variations, but, you know, and choices within inventory accounting, which, you know, immediately, like I said, you really need to have a narration of what's going on, because if you're just doing that old memorization trick, it's not going to help. You need to have a story, or else it's going to go out so fast because there's too many things going on.